not, and don't abandon what's not unless you have very, very good reasons for doing so. And those reasons could be many. I mean, if you've, after watching video number 1 and video number 2 of this series, realized that you're trading something that isn't using good sound logic or isn't using good position sizing and money management, if you're involved in something like that that's losing money, well, that would be a good reason to abandon something, even if it's in a dip, because that dip might just simply get worse with no hope of recovery. But again, if you're in something that you've researched well, that you feel has got all the components it should have, and has, let's say a long-term track record of success, then in that case, don't just arbitrarily bail out because it's gone through a bad period. And by the same token, don't jump in with everything just because it's recently gone through a good period. Okay, let's look at some of the other common errors that tend to come up. And one of the biggies, and there's a lot of errors, and quite frankly, I've said this before in the other series, we could spend hours and hours talking about all these things, but for the sake of time, I'm trying to really hit on the high-level points that matter the most. And one of the big ones is my current trade must be a winner bias. And this is a real problem. This is a huge psychological hang-up. There is a tendency for people to want, or to try to make, I should say rather, their current trade be a winner. And even though they understand that there's going to be a series of winners and losers along the way, and it's going to be a mixture, and they've told themselves at the beginning they're fine with that, they understand that, it doesn't change this natural tendency to want to make your current trade or your current investment work out. And traders will make all sorts of errors trying to increase the odds that their current trade will be a winning one. They'll do things such as get out of winners at a profit, because they figure if they don't get out now at a profit, that it may turn into a loser. So that's one way to assure themselves that their current trade's a winner. Just get out of it with a profit. And of course, if you're in a good trend following system that lets profits run, you could be making a huge mistake by doing that. You might get out at $1,000 profit only to see the thing turn into a $25,000 winner. Or people will play with their losses. They'll have a losing trade, and in order to make sure, or try to make sure that their current trade's a winner, they won't take that loss. They figure, well, if I hang on a little bit longer, give it a little bit more rope, this thing could at least maybe get back to even and possibly turn into a winner. So big, huge hang up to just be aware of, and that really is step number 1, is be aware of the fact that there is this inborn tendency to want to try to make your current trade be a winner. And winning in the markets is not about winning percentage of winning trades. So many times you'll see system developers try to impress one another by showing them how large of a percentage of winning trades they've got. This thing is right 80% of the time, or you'll see advertisements in these magazines 90% accurate, or whatever the case may be. And the fact of the matter is again, going back to William Eckhart, the market wizard, he made the comment that the percentage of winning trades is probably one of the least important statistics, and in fact may even be inversely related to success. In other words, in his opinion, the lower the percentage of winning trades, the higher the probability it's probably a winning system. And this really does hold true for a lot of trend followers, because think about it, you could be right 90% of the time and make $1 each time you're correct, and the one time you're wrong, lose $1,000. And you've got a lousy system in spite of it making money 90% of the time. And by the same token, you could have a system that's only right 10% of the time, and the first 9 trades you lose $1 each, and on the 10th trade you make $1,000. And you've got an extremely profitable system in spite of the fact it's only correct 10% of the time. So this is another psychological hang-up, which is the desire to increase the percentage of winning trades. It just simply is not that important to have a large percentage of winning trades. What is important is that what you win when you're right is significantly greater than how much you lose when you're wrong. That is what matters. Okay, let's talk about the proper mindset that you do need to have in order to be successful. And point number one that I want to make again is that having lots of losing trades is totally normal, and it is a completely natural part of successful trading. And that is just something that you simply have to become comfortable with in order to be successful at trading. Trading is full of a lot of losers. There's simply no way around it. And until you become totally comfortable with that fact, you'll have a real psychological problem being a winning trader. Successful trading is not about accurately predicting which way the markets are going to go. In nearly 20 years of research, with the most advanced research platforms you could possibly have, I have yet to find anything that really is that good at predicting which way the markets are going to go. You're lucky if you're 60% accurate. So what is successful is to treat this as a probabilities game, as a probabilities matrix. It's similar to the way that an insurance company operates, or similar to the way that a casino operates. When you think about it, if you own a casino, the way that you make money is not by predicting which machines are going to pay out and which ones aren't. If you knew which machine was going to pay out $1 million today, you could go put an out of order sign on it first thing in the morning, and that way you wouldn't have to pay out $1 million, and you could predict that's the machine that I need to turn off. Well, of course they don't do that. What they do is they have a probability matrix, and they know that they have an edge, and they know that if they apply that edge over and over and over again, that ultimately they're going to be successful and make a profit. It's the same way with an insurance company. Insurance companies don't know when they're out there writing policies whose house is going to burn down or when there's going to be a hurricane or anything like that. They simply can't predict those things. But what their actuaries have done is they've looked at a huge sample size, and they know that they've got an edge, and if they apply it over and over and over again with enough people, that they're going to come out ahead in spite of the losses that they're going to have to pay out. And this is really analogous to trading. Very, very similar concepts here, which is that you get an edge, you have the proper entries and exits, you have the proper position sizing, and then you have the proper trading psychology, and you apply that edge time and again, and that's where your success comes from. Okay, that's pretty much it for this series, and I want to once again thank you for taking the time to tune in. I hope that you found it informative and helpful. And for those of you that may have questions or want to talk to us about our relativity trading system, feel free to give us a call directly. We'd be more than happy to help you however we can. Until then, take care, and I wish you a profitable day.